Robert Atkinson, COO of Mirai Asset Securities, and the call's moderator. We are delighted to welcome David Seitz, a 17-year veteran of Grant Thornton. At Grant Thornton, David is the international technical leader firm, and he's based out of Washington, D.C. His area of practice encompasses working with U.S.-based multinationals, foreign-owned inbound U.S. corporations, closely held businesses, as well as high-net-worth individuals. So David is very well qualified to lead our discussion this afternoon entitled U.S. Tax Reform, Opportunities and Challenges. Before I introduce David, I'd just like to remind the audience that we pretty much have a hard stop at 1 p.m. David has some prepared remarks for us. Then we'll go into some questions that I will be asking David, and then we'll open it up for Q&A. I'd also like to call the audience's attention to the fact that at the bottom of the screen, you have the ability to send questions to David during the presentation. So David will see those questions, and he can answer them if you'd like an answer as he's going through his comments. Before I turn it over to David, though, I do want to acknowledge and thank our sponsors, without whose support this call would not be possible. And you can see the slide right in front of you. Our platinum sponsors include Alston Bird, Baker Tilly, Bloomberg, Full Systems, Grant Thornton, New Mountain Capital. Our gold sponsor is Benesch, and our not-for-profit sponsor is Kaya. So without further ado, welcome David Seitz.
Bob, I really appreciate that, and I appreciate everybody being here and the opportunity to talk to you guys about tax reform. And so I guess, everybody on the call has probably heard. We got probably the most significant tax legislation at the end of December that we've seen in 30 years at least. And so what we got was we got a sea change in the world of U.S. taxation. And I like to tell people that the way you evaluate this is forget everything you knew about how you used to structure things from a tax perspective and build off a clean slate and start anew and think about what's the most tax efficient way to do this. As we go through this presentation, what you'll hear are the sea change of taxation in the areas of the corporate rate, through deduction, change to foreign operations and the taxation of foreign operations and investments have all led people to reach drastically different conclusions about the way investments are structured, the way investments are exited, the way economics of deals might be impacted, and so forth. So the bill largely became effective on January 1st, 2018. We'll talk about some of the other different effective dates. There are real-world consequences that are going on right now for companies vis-a-vis repatriation taxes that came up out of the bill, and we'll talk more about that. And there are decisions that need to be made here in the early quarters of 2018. Now, the other thing I'll say is this bill produced an awful lot of ambiguity. And what I mean by that is we had 50 days from the time the first legislative text was introduced by the House Ways and Means Committee, and that was on November 2nd. We had days until the president signed this bill into law. That is lightning speed for 500 pages of changes to our already incredibly complicated tax code. And so where it leaves us is in a situation where there are a lot of unanswered questions, and there are not common positions developed in the industry or amongst similarly situated taxpayers. So people are left to try to make decisions without a lot of guidance from the IRS, without industry norms. And so there's a lot of risk and opportunity, and that kind of gets back to the title of our presentation. And we'll talk about some of those challenges and opportunities as we go through today's provision. I encourage you guys to ask questions. We will go through as we're talking. I'm going to leave up slides here that you're going to see if you're on the WebEx. Go through what the major provisions are of the bill, provide a little bit more detail, but I'm not going to speak to the slides necessarily. As Bob said, he's going to ask me some questions and I'm going to react. So, Bob, why don't you jump right in and tell me what you guys are thinking about and what your questions are.
That sounds good, David. And again, based on your opening comments, it sounds like we live in very exciting and or challenging times, depending on your vantage point. So let's begin with the tax legislation, okay? As you noted, it was enacted at a relatively rapid pace. How does that impact the implementation of the provisions for business taxpayers?
And so probably the biggest thing, that I mentioned is the lack of guidance. And so we've gotten from the IRS notices on this bill, okay? Basically, the notices say, look, we intend to issue regulations, and this is what the regulations are going to say. Both of them deal almost exclusively with the one-time repatriation tax. We'll get into what the notices talk about a little bit as we talk about the provisions. But the point here is there were 100 regulatory grants given by Congress to the IRS as part of the bill. So basically what that means is in the legislative text itself, there's 100 spots where they say Treasury, IRS, we write rules that are going to make this legislative provision work, whatever provision that is. Until it's time as we get those rules, we're much in the dark on how we should interpret that legislative text and what positions are going to become acceptable and normative going forward. So that's one big thing. The other thing is that the effective date of the provisions, I said, are generally January 1st, 2018, and we got the bill on December 22nd, 2017. So those of us that took some time off over the holidays, this hit us smack in the middle of the forehead right before that time off, and people came back, went home for the holidays and came back on January 2nd to a whole different world of taxation and a lot of looming issues. And so people are just now digesting. We're about a month and a half out from the signing, well, not even a month and 3 days, I guess, out from the signing of the bill. And we're already starting to see progress on people identifying issues. We're seeing progress on people maybe resolving certain issues. But certainly we are definitely in the thick of the New World Order of U.S. taxation. Final thing I would say, Bob, that's really important is the international provisions in this bill. One of the that they did was transitioned from a worldwide system where we had deferral of foreign earnings, and so you could earn money in a foreign corporation as long as you didn't pay a dividend back to the United States. The U.S. tax was deferred on that. The system went away, and as part of that system going away, Congress said, look, we're going to deal with all those old earnings. We're never subject to U.S. tax, and we're going to have this one-time deemed repatriation. The way they wrote the bill is that one-time deemed repatriation happened on December 31st, 2017. So if you pick up the Wall Street Journal, talk to any clients that are dealing with this, for your taxpayers, they're trying to figure out what the financial statement ramifications are. And a lot of times it's a very negative hit to people's financial statements. So you're seeing a lot of earnings reports come out, and you're seeing a lot of reaction in the market to what the impact of the tax bill is. And I mean, it's just the amazing pace of change and the speed at which this stuff has to be implemented. Again, I mean, just the fact that the bill came through in 50 days just didn't leave people a lot of time to assess and plan for what this was going to do from a financial statement perspective or from a cash tax perspective. So we're all drinking from a fire hose a little bit. I would say for folks on the phone, when you have questions, I think the thing to do is reach out to experts in your industry, talk about what other people are seeing, watch for IRS guidance, but you really have to dig in and assess this stuff, like I said, from kind of a fresh perspective, clean plate.
David, given the fact that, as you say, we're drinking from a fire hose, I mean, so much has happened in such a relatively short period of time, Can you give a summary or an overview of the major tax provisions that were part of the Tax Cuts and Jobs Act?
Yeah, absolutely. Absolutely. So let's talk about what we got. I'm going to look at this as three buckets. One, I'm not going to talk a whole lot about, but we got a significant set of individual changes. And the biggest one, is a lot less people are going to be able to itemize their deductions. We rid of personal exemptions. We got a much higher standard deduction. So for folks that were filing a Schedule A, unless you've got significant mortgage interest left, you may not be filing a Schedule A anymore. So we saw some simplification on the individual side. We also saw a lowering of rates on the individual side, and so we saw an expansion of brackets at some lower tax rates. We saw the rate of 39.6 come down to 37. So some helpful stuff there on the individual side, and mostly keeping in line with what we expected. The two other parts that we got were we got the business provisions and we got the international provisions. So when I say business provisions, I'm talking about the domestic provisions that impact us. And there's some slides up here that kind of show what these are, and I'm going to talk about them in the order that they're up because I think these are the most impactful things. For me, this one is we got a 21% corporate tax rate, okay? So we had a 35% rate. That's a 14% improvement. And, we lived in a world where avoiding U.S. corporate tax was the gold standard for tax planners because the corporate system imposes a double layer of taxation. And so what you got, your income was taxed at 35, and then it was taxed again when you made a dividend at 20 out to the investor in the corporation. That first incidence of taxation is now down to 21. So it's a big deal. You look at operating a business through a pass-through versus operating a business through a corporation, and you have a lot more parity in what your ultimate taxation is. But the corporate incidence of taxation, the first level of tax before you pay the second level of tax, is much lower because of the way that works. So let's work through an example real quick just to highlight what you get. If you operate through a pass-through and your business earns $100, and that pass-through is ultimately owned by individuals, and this is very common in the asset management industry, that you'd make an investment in a portfolio company, you'd have that portfolio company taxed as a pass-through, and the income would pass through at least to your domestic investors. A lot of your foreign investors were blocked, but the income would pass through and it would end up on somebody's tax return. And what you'd see now is you'd see roughly a 37% rate. And put aside the special deduction for pass-through income that we'll talk about a little bit later. So you've got immediate tax rate of 37%, and then generally no additional taxes, distributions come out of that investment, whether they be for taxes or use other distributions of liquidity. So you're on the hook for that 37 if you're in the top tax bracket right away. You invested in that same business now and structured that investment as a corporate investment. You're faced with this decision point. I got a 21% rate and a 21 now when the money's earned, not 37. Then when I make distributions to my investors, they're going to pay another 20% on the $79 that was left over after the corporate tax was paid. So your effective rate is right around 37, 38%. So the question becomes, do I have liquidity from my investment, or can I take advantage of this rate reduction at 21% and defer that second level of tax for a long period of time? I can tell you that this is a question that a lot of folks in the fund industry are thinking about. And for people that are generally making distributions out of their investments, partnership structure seems like it's still working. But for folks that money reinvested in those portfolio companies that have a little bit longer of an investment horizon, we're certainly seeing people think, which is funny because 6 months ago, but that was heresy to say I was going to invest through a corporation just because you were disadvantaging yourself so much from the double tax layer. But now the game's changed there. So the 21% is a big deal. The thing that I think is significantly important for capital-intensive businesses and for deal structuring is we have some different depreciation rules. And so we will have provisions that the next, call it 6 to 8 years, you're going to see the ability for you taxpayers to immediately expense investments in depreciated property. So I'll paint a picture for you. If I, David Seitz, go out and I buy a business and $10 million on that business, and the business has significant PP&E in it, let's say it's a manufacturing business or a distribution business, what I'm going to be faced with is figuring out how much of my $10 million gets allocated to property, plant, and equipment, i.e. depreciable assets. In the old world, I would write those depreciable assets off over 5, 7, maybe 15 years, depending on what type of asset they were. In the new world, it almost sounds too good to be true, I get to expense that investment in depreciable property. In addition, the business goes forward and continues to make CapEx, whether they're replacing equipment in the plant that becomes obsolete or they're investing in expanding capacity, capital expenditures are also going to be deductible immediately at 100%. Exciting opportunity, but one that has to be thought through pretty clearly, because there'll be some other things that we're going to talk about where what I'm finding in the market is a lot of people that are running portfolio companies and the operating companies are saying, well, hold on a second, it not makes sense to take this full depreciation deduction because maybe I'm pushing myself into net operating losses or along those lines. So bill on capital expensing. The other comment I'll make about that, which I think is relevant to this group, is the structuring of deals in this case are going to be more favorable to asset transactions. And what I mean by that is there's going to be a premium in the market for folks going out and looking at asset deals because you're going to get that immediate tax benefit. So it's almost like you're being subsidized to the extent you acquire fixed assets because you're going to get that immediate tax deduction at the acquiring company. So I think we're going to see a shift in deals towards straight asset deals, potentially 338 election deals. I think that we're going to probably have to work through what that's going to mean for the investment industry. So that's a big one.
Which David, I think brings up a very interesting question. Again, to go back to your analogy, clearly we're drinking through a fire hose with this. The change is tremendous. So the investment industry, do you see that in our industry being impacted by these regulations?
Yeah, so it's a good question, right? So what are we gonna see in opportunities for alternative investments? I can tell you that kind of what I'm hearing in the short term is one of the ways this is working through is we're certainly seeing a lot more capital come to the United States or potentially coming into the United States as a result of this, right? So what that's going to do from the pricing of alternative investments is going to be one that I think what we're going to see is maybe the cost of capital come down a little bit more than we've seen, a pretty cheap cost of capital in the meantime. And I think returns are probably going to be somewhat blunted, if you will. I think that has to come into play, right? Because now with the tax reforms and now with the ability to invest in the U.S. and to reinvest in the U.S., I think that you're going to see more capital come in, as opposed to focus on external or foreign investment and so forth. I also think, extent the carry is important. I think you're going to see people making some different decisions about how they structure some of their investments vis-a-vis the exit for the investment managers, and we'll talk about the carried interest rules. But unfortunately, right now, given that we're 35 days into this, it's difficult to see how this is going to play out. We're really just starting to identify, all the issues, Bob.
It's early in the game, David. Yes. So let's go back to and again, if I understood you correctly, basically you're saying that the corporate tax rate reduction, for all intents and purposes, is really the centerpiece of this legislation. If that's the case, can you talk about the consequences that it might have in the transactional context?
Right. So, I mean, we've kind of touched on some of those. So, if you're looking at an investment, okay, and you say, look, do you want to make an investment through a flow-through structure, or do you want to make an investment through a corporate structure? The answer before was pretty obvious, I think, for a lot of people, if you had the opportunity, was, look, I probably want to go through a flow-through structure because I just get a better tax answer. Now, like I said, that's a different consequence. The other thing that we saw in the tax law, which is interesting, and in a lot of structures, was monetizing deal cost and monetizing the one-time charges like transaction cost and things like that. Those are now worth less because they were worth 35% before, but now they're only worth 21%. So if you can generate net operating losses, you can no longer carry those net operating losses back. And so there was a chance, right, in the old deal setting, you'd go in, you get a company, you'd put transaction cost at the company, you could get a nice tax bump because you'd carry that NOL back that resulted from those transaction costs, and you'd get back your 35% money from prior years. One thing the tax law did was it eliminated the ability to carry back NOLs. So NOLs carry forward now under the new tax law, Bob, and that's causing some different thinking from people about generating deductions as part of deals and the ability to monetize those deals. Because people used to use that money. For example, if you were going to do a leverage distribution, you knew you were going to get some cash from the tax bump, came from the transaction cost and the carryback of the NOL. You're no longer going to have that cash, so you have to put that in. So it's things like this that keep popping up as the discussion goes on, so I think that 21%, like I said, it's a big game. It's a big game changer. The other thing I want to talk about is the interest expense limitations, because I think they're really important in this. So leverage, right? The asset management, people use leverage. There is a sea change in the ability to deduct to deduct interest expense. Excuse me. So, before, if it was external third-party lending, we didn't have any limits really on the ability to deduct interest expense, with some caveats for certain equity reduction transactions and things like that. Now we have significant limitations, right? Now you are limited to your basically what we're calling tax EBITDA. So it's called adjusted taxable income in the bill, but what it is it's your taxable income adjusted for tax, depreciation, amortization, interest, and so forth. So it's an EBITDA concept with taxable income. It's going to apply for the next 4 years. And then after that, you're going to be limited to 30% of your tax EBIT. So it's 30% of tax EBITDA until 2022. And post-2022, you're going to be limited to tax EBIT. I tell you that most of the companies that I'm talking to and the investment advisors that I'm talking to are having significant interest limitations on some of the debt structuring that they've put into deals. So the question becomes, do I rearrange my debt scenario where I have less leverage to U.S. companies? And of course, on the international side, we're seeing people say, I want different debt structures, right? I want multi-currency, multi-borrower deals next time I roll into a debt agreement. And I'm going to be able to push debt out to foreign operations to align with where my EBITDA is. Because if I'm not going to get the benefit in the United States, because it's going to be disallowed and carried forward, I get the interest somewhere else in my structure. So from an alternative investment perspective, you got to question what's going to happen over the next 3 to 5 years if there's less demand for debt, mezz debt, other types of debt here in the United States. If that demand moves offshore, how does that impact the big picture for you guys? And so that's what I'm seeing from my multinational clients. I talked to, a couple of Fortune 50 companies. I talked to a number of privately held companies that have, investment money coming in from institutional investors and PEs and everything else. And what they're saying is, look, it makes sense for us as we roll out of our term agreement to reshape that agreement, try to align our debt better with our EBITDA. And the reason that's important is in the old world, it was a brainer. You wanted your debt at the 35% jurisdiction, right? You wanted it in the U.S. because that's where your highest tax rates were. That's a perfect example of you forget everything you knew before, and you look at the New World Order, and now it just maybe doesn't make sense. Maybe I want my debt in Canada if I've got a big Canadian operation. Maybe I get a 26% benefit in Canada. Maybe I have EBITDA in Canada that allows me to deduct that if there's a Canadian interest limitation. So I think that's a pretty big game changer. I think that the interest limitations here are going to really impact the debt and where that demand sits now in the global economy.
So the borrowing space clearly will be greatly impacted as a result of the tax reform. That's a net of it.
I think so. I really do. Now, we're going to have to wait and see. I mean, nothing happens in isolation, unfortunately, in the economy, but I think that's right.
What about net operating loss deductions? Will there be changes in this area?
So there's absolutely changes in the net operating loss deduction area, and so I touched on them a little bit, but let's just talk. So 2018 net operating losses, so kind of the world that we live in now. You incurred a net operating loss at a corporate level or at an individual investor level. Net operating loss could be carried back 2 years, and you could recover money from past that you paid in the previous 2 years. And it would carry forward for 2 years. They were generally available to offset all of your regular taxable income. There were some provisions where under the old alternative minimum tax system that they got rid of as part of this tax reform legislation on the corporate side, where the haircut and you'd pay a small tax, but you got a credit for it later. So, the big sea change now is two things. Post-17 NOLs are not going to be able to be carried back. So there's no way to immediately monetize an NOL, even if you paid interest, say, the year before. All right, taxes, the year before. So that's a big deal, right? Because the ability to immediately monetize some of those net operating losses was something that people took into account when structuring flows. The second thing is able to be carried forward, and the period's no longer 20 years. They're going to be able to be carried forward indefinitely. People, the 20-year carry forward period wasn't a problem because it was like, look, if I'm not making money in 20 years, I'm probably not going to be around, so I should have taxable income to utilize these things. For some people, it was a problem, but for the part, the switch to the unlimited is a good thing, not a tremendous thing for people. The big difference is NOLs are now limited as to how much taxable income they can offset in the year that they're carried forward to. So generated a $100 NOL in 2018. And then in 2019, let's say you've got let's say you have $100 of taxable income. You can only offset up to 80% of your taxable income with loss carry forward. So you're going to end up paying some tax, and there's no credit for that. And your net operating loss is going to take longer to use because you're going to be limited to this 80% of your taxable income limit. So net operating losses have changed a little bit, and we've accelerated some tax that's going to happen in those situations. I think what that means is we're going to see people, probably not as bullish about the ability to kind of immediately monetize those. I think there's a little bit of a slowdown from the net present value of the cash associated with your net operating losses. So big there, something that people are going to have to get used to in their planning models.
Okay, and let's swing back now to the international aspects of the legislation. Could you provide us with a summary of these provisions and how they may impact investment decisions? And I recognize you probably covered some of this before, but let's see if you can summarize the international aspects of this legislation and their impacts.
So what you got on the international side was you got three significant. I think I have a slide here. So there we go. I think so. Okay, perfect. You got three major things that I kind of talk about, right? So before I get into the three, let me just back up. Let me just say this. They didn't get rid of any of the complications in the international space. They just laid a lot more complications on top of what was already a very difficult thing. So the grade on simplification in the international area is an F on this one. We made it immensely more complicated. But what they did was this. They moved to what I call a quasi-territorial system, away from our worldwide deferral system. What they really moved to, though, is a worldwide system with a minimum tax. They essentially ended deferral and gave you a break on a minimum tax. So let me explain what I mean by that, because I think it's important. I mentioned under the old world, income was deferred to the extent you earned it in a foreign corporation outside the United States, and it was taxed when a dividend was repaid to the United States. Well, the net result was most people took advantage of that deferral and tried to defer those earnings as long as they possibly could to avoid the significant U.S. tax that would occur when that money was brought back to the United States. And so you heard about people with these offshore earnings of billions and billions of dollars. The idea was, look, I'm not going to pay U.S. tax because I'm never going to bring that money back. So we wanted to end that system. So we moved to this territorial system. Well, we, the government, wanted that system. So we moved to this territorial system, and we said, look, what we're going to do is we're going to tax all those earnings that you never brought back as a one-time tax, and we're going to tax them at a rate of 8% or 15.5%, and that tax is going to happen, like I said, in 2017. And then going forward, we said to the extent you have earnings that are specific types of earnings outside the United States, you'll be able to bring those back without any incremental U.S. tax, which everybody thought was a great deal. But then and they said, well, look, we're concerned that what's going to happen here is everybody's going to engage in tax planning where they shift their earnings offshore, pay very little foreign tax, and take advantage of this new U.S. system to bring those earnings back with no additional corporate tax. So we're going to build some curbs into that system, and that's what they did with this concept of global intangible low-taxed income. The acronym is GILTI. You guys have probably heard about the GILTI tax. The GILTI tax is this. On an annual basis, to the extent you've got a business that has international operations, business is going to have to look at the foreign income from those international operations, and they're going to measure it this way. They're going to say the only thing that escapes U.S. tax is 10% of your tangible property investment outside the United States. That income is going to be subject to U.S. tax at a rate of 10.5% on a real-time basis with allowance for certain foreign tax credits. Okay? So when you put that all in a box and you mix it up, because of the way they haircut the foreign tax credits, essentially the way this works is I pay about 13.125% out of the United States on my foreign earnings, or I have an immediate tax in the United States. If I pay 13 on an aggregate basis outside the United States on my foreign earnings, I have any incremental U.S. tax, and then I can bring that money back tax-free. So what we really got, Bob, is we got a worldwide tax system in my mind with a minimum tax. And so long, I mean, we didn't really get the territorial system that I think we all bargained for. I don't think that I think just now when I'm out in the industry and talking to investment managers, what I'm hearing now is people are just starting to piece this together, that there's real world cash flow implications to this. So the structure in place where you've got foreign earnings, effective rate 6 or 7%, you all of a sudden have a U.S. cash tax drain on your business now every year as a result of that. And there's other situations where this stuff can creep up and get you, to the extent you have limitations on your ability to take foreign tax credits. There are situations where if you're in net operating losses, it becomes pretty onerous. And then the list goes on and on where this GILTI tax is very punitive for U.S. companies and something that really has to be modeled out. So the GILTI tax is kind of the stick that I like to refer to. That's the stick that keeps you from abusing the dividends received deduction. The carrot, if you will, is they said this: look, we incentivize you to not shift income offshore. So what we're going to do is we're also going to give you an incentive, and I think this one's not got a lot of airplay. We're going to give an incentive to export from the United States. So the idea here is income associated with export transactions and intangibles to remain in the United States. So we put in the foreign-derived intangible income provisions. And what those provisions essentially do is if you export export-heavy businesses are much more valuable now if you're thinking about from an investment perspective, because extent you export from the United States and you recognize that export income in the United States, and this is goods or services, and meet the definition of foreign-derived intangible income, you're going to get a 13% rate, a 13.125% rate on that income. And the reason is they built in a deduction for 37% foreign-derived income. So very exciting. There's some provisions where you have to haircut that amount a little bit, but very exciting for U.S. exporters, especially in the technology space, and reasons for that. But U.S. exporters that are recognizing U.S. taxable income that have kept that IP onshore, or that can move that IP back onshore, could be in a position to see a 13% effective rate, which, I tell you, you would have told me 6 months ago that I could have some people plan to a 13% effective rate. That's pretty good from a reinvestment perspective.
So this could benefit a company like Apple.
I mean, if Apple is selling products abroad and they choose to now have those sales happen from the United States, they will see a U.S. tax rate of 13% on that money. Now, the challenge is going to be is for people like Apple to roll out of the old structures that they had, because Apple obviously didn't have any foreign sales, any sales of the foreign market. Not a lot, I shouldn't say any, but not all of their sales associated with their foreign market came through their U.S. return. They had them all structured so that they could avail themselves of deferral.
Right.
So the idea, the policy perspective behind these rules is bring that IP back to the United States, develop that IP here, create jobs here, export from here, and we're going to give you a really attractive tax rate.
Interesting.
So very, very interesting provision.
Yes, and David, I have a couple of questions here from the audience before I ask you to summarize. But so let me give you one of the questions from the audience. A big topic in the press right now are the earnings reports where companies are taking a one-time hit from tax reform. So can you talk about how this is happening and what we can expect in the future on this?
Yeah, two things are driving that one-time hit, and folks in the room that are familiar with kind of the financial statements of companies will understand this one, but I'll try to explain it high level. So the first driver of this is you have differences where income is recognized for GAAP at a different time than income is recognized for U.S. tax purposes, or a deduction's recognized for GAAP at a different time. You end up with either deferred tax assets, meaning you're going to get a future tax deduction that you've already taken for GAAP purposes, or deferred tax liability, meaning that you're going to have future taxable income that you've already recognized for GAAP purposes. Those deferred tax assets and deferred tax liabilities on the balance sheets of companies. And those deferred tax assets and deferred tax liabilities, up until the time this bill was signed, were measured at 35%, because that was the U.S. effective tax rate that was going to apply when those deferred tax items became realized in the tax return of the company, right? Makes sense? So I take a depreciation deduction for books, but I didn't take it for tax, so I've got a future deduction for tax. If deduction's $100, at 35%, it's going to be worth $35 to me. So I've got a $35 asset sitting on my balance sheet. And the idea is I'm accounting for the future tax effects of the income that's already been recognized for GAAP. Well, these assets and liabilities are huge. And for companies that had significant assets, you have to mark those down from 35 to 21.
Okay.
So you lose 14% on those. So losing an asset, okay, which causing you a significant earnings hit, because marking down from 35 to 14 grew your P&L. And so you get an expense, P&L, associated with the revaluation of those assets, and that happened on the date that the bill was signed, which is December 22nd, 2017. So that should be a one-time thing, right? Because you've marked your assets to the fair value, or the appropriate tax rate, the 35 rate versus the 21 rate, and you've lost that benefit. Conversely, for companies that have liabilities, that liability no longer exists at 35%. That liability will now be paid at 21%. So they should see an earnings benefit from it. You know, ones that you see in the press and the ones that have reported significant hits associated with this, primarily because they had tax assets that got revalued. The second thing you're seeing, and I alluded to this earlier, is you know, you've got this one-time deemed repatriation of all these foreign earnings that you deferred for years and years and years, and you've got the tax associated with that. And so you've got a 15.5% tax or an 8% tax, and that's driven by whether or not those foreign earnings were sitting in cash or whether they were reinvested in non-cash assets outside the United States. I say cash, it's, you know, a broad definition of cash. So you're seeing people accruing that one-time tax. So those two hits are the primary drivers of what you're seeing. So Bob, to answer your question, what I think is going to go on here is in the short term, you're going to see people's earnings challenged by the one-time tax effects.
Okay.
But in the long term, I think we're ultimately going to see effective rates come down. And cash flows of businesses are be stronger because you're going to have less tax drain. We should see better, yes, you know, obviously EBITDA numbers are EBITDA numbers, so tax stuff's taken out of there anyway. But from a cash flow perspective, we should see stronger numbers going forward, and we'd also see better EPS numbers. So I think this is a temporary thing. It's going to take about 2 years, maybe 3, to work itself all through the system.
Okay, which I guess should somewhat coincide with the election cycle to a certain degree. Got another question from the audience for you, okay? The 100% expensing provisions that you did before, they're especially relevant to asset managers. Can you talk a little bit more about that in detail, please? So, I mean, I guess they're especially relevant because they impact the cost of the investment is what I'm hearing, right? So I go out and I look at an investment and I say, you know, all right, if I buy the assets of this business, I'm going to get an immediate tax benefit, which manifests itself in a net operating loss because the benefit's so big, or maybe I'm able to offset a significant amount of taxable income that I would otherwise have a tax liability on. So big deal there because it's immediate cash in the pocket of the business, which allows the investors to then make a decision about whether they return some of the capital that was originally put into the business, or they use that money to reinvest or pay down debt or whatever the case may be. One challenge is, right, is deal structuring. So what I'm hearing from a lot of investment managers is I'm looking at deals, and from a tax perspective, a lot of people did deals, you know, there's a lot of ways people did deals, but they all were one of 3 general flavors, maybe 4. You bought stock. If you buy stock, you're stepping into the shoes. There's no asset purchase. You don't get access to, I purchased the assets inside of the business. So you're not going to see any benefit from these expensing rules. So stock deals are kind of the way stock deals were pre-law. This one is, I make stock deal, but for tax purposes, I treat it as an asset deal. And one is taxed now the same way as a true asset deal is taxed. So those are so-called 338 deals, right? So in those deals, you're going to see this significant benefit because they're treated as asset acquisitions. You're going to see this immediate cash tax benefit or wiping out of your cash taxes and creation of an NOL that can be carried forward to eliminate future cash
taxes. Doubling deal is the last kind of deal I'm going to talk about. And deals where you went in through partnership structures and you bought partnership interest. And those deals, for folks on the phone that have delved into the tax, are sometimes referred to as 743 deals. And the idea there is you do get a basis adjustment when you buy a partnership interest, but you're not going to be able to avail yourself, probably, this is an open issue, but probably not going to be able to avail yourself of the expensing provisions in that type of deal. So it's kind of like an asset deal, but because you're getting a basis adjustment, a tax-deductible basis adjustment in those types of deals, that tax-deductible basis adjustment is not going to be recovered immediately. It's probably going to be recovered over a 15-year period. So the upshot of all this, Bob, is the expensing provisions are such a big deal because it now drives what type of deal you want and what cash flow is going to look like post-deal based on what type of deal you get. I think that's really important in the asset management space, right? I mean, everybody's looking at cash flows, everybody's looking at ability to service debt and ultimately return capital to investors and to get them their return, so that you can get to, the place where obviously you want to be on your investment. So that's the driver, I think, that a lot of investment managers, the calculus that they're kind of going through now.
Okay.
Yes.
That's excellent. And David, you've covered a tremendous amount of territory in not 50 minutes. But I think in the interest of time, what we'll start doing is maybe talking a little bit about from an implementation standpoint. Where do you see this going? What challenges are taxpayers and advisors going to have? What further guidance, if any, are you anticipating from either Treasury or the IRS at this time? Because as you alluded to in your opening comments, there has been maybe conspicuous is the wrong word to use, but certainly a lack of guidance. Will that change?
Yeah, I mean, look, I certainly think we're going to get guidance, okay? The question is, at what pace are we going to get it and in what order? Right? So now, Bob, we're seeing a lot of, in D.C., we're seeing a lot of public comments from the IRS, and we're starting to piece together what guidance they're working on, maybe what they're going to release next. And so we've seen some guidance on some of the international stuff, specifically this one-time tax to be reported in calendar year taxpayers' 2017 return. That's been important. We've got some guidance there. There's still some open issues. We're hearing are the interest limitations are on the list of where we're going to see some guidance. Also hearing that the other international provisions, like the global intangible low taxed income and the foreign-derived intangible income, are also high on the list of where they're going to issue some guidance. But remember, the IRS is not exactly well-funded. And with Republican control of the administration and both chambers, I don't think we're going to see a significant increase in IRS funding as part of any spending bill. So the IRS is going to continue to be strained. You got to remember, they had a lot going on before this happened, right? You've got an interim commissioner. You've got a lot of unfilled posts in the IRS.
Recovering from scandal.
Yes, recovering from scandal. So you got a situation where you have an agency that was already struggling to keep up, that now just got a whole lot more put on their plate. So you can only expect so much. So let me tell you what I'm hearing and what.
And can I just ask you one quick question?
Yeah.
Net. The impact of these regulations, we say it adds more complexity, or does it make things simpler?
Well, regulations, you mean, or the fact that we don't have them?
This tax bill, when
settles
on this.
The tax bill adds significant complexity. And the lack of guidance, I think lack of guidance adds significant risk, okay?
But I thought one of the goals of this legislation was to streamline things.
Yeah, on that front, from a business perspective, there's now. I mean, everybody agrees. The streamlining you can potentially point to is on the individual side. On the business side, you see any simplification. You saw addition to complexity. Like I said, the international side is, I would say it at least doubled from a complexity perspective with the addition of these provisions, right? Which is good for guys that are in my business, but not great for taxpayers, because the idea here was spend time figuring out how to administer all this stuff and more time making money, right? And we didn't get there. Let me tell you what tax guy at a fund manager that I talked to told me. He said, what I'm afraid of? I'm afraid I'm going to have to make a decision this year. I'm going to choose to go a certain direction with a planning strategy or with how I structure a deal. 3 years from now, I'm going to be the outlier. It really summarizes for me what we're hearing from a lot of people is we don't know where the industry is going to be. Making decisions now is difficult because you don't want to be the outlier that took the overly aggressive or the overly conservative position. And 3 years from now, guidance comes out or you figure out the entire industry is in a different place on a particular issue, and you've either overexposed yourself or you've left your investors in a worse off place from a cash tax perspective. So that's the struggle right now for people structuring deals and people making decisions about what to do from a tax perspective and what the economic impact is going to be is, look, am I going to be an outlier 3 years from now when all this guidance kind of settles? I'll layer on top of that, and you alluded to this, Bob, but it's a big deal. We got elections coming up, right? So you could be making decisions in the here and now, and come 2018, we could have a change in control, at the Congress level, and then those in the years after that. So, the way politics are, and I'm not going to get political, but the way politics are now, you got to wonder: are the Democrats going to run on, hey, we're going to undo a lot of the provisions in that tax bill? And tough time to be a decision maker, right? Because you just don't know.
And certainly beyond my pay grade, but if you go back to the 90s, when the Clinton administration began in office, it had both houses of Congress were aligned with it, at least ostensibly. And it really wasn't until we had a divided executive and legislative branch that we seemed to be able to make progress. And progress through compromise, I might add. So perhaps that will happen here if we wind up with a more divided government. And a more divided government is, on paper at least, the Republicans control the executive and the two both aspects of the legislature. But we do seem to have some jam here.
Absolutely. And so the point is right, when you put all this in a box and you shake it up, you got to make decisions today, right? You're going out, you're doing deals. You're not going to stop doing deals. You go out, you do deals. You got to make a decision on what you do with some of the tax stuff. You got to talk to your partners about what you're going to do with their carry, for example. And you say that you're not going to be an outlier in 2 years. And then you also have to say, am I locking myself into something long term where it may change and I may have to reevaluate this stuff? So it's a very opaque situation as to what the future looks like. And I think it causes people a lot of heartburn, and I think that it's going to cause people to invest more time in thinking through this stuff, feel what's going on, working with their advisors, and decisions about how much tax risk they want to introduce into their business.
Yes, excellent. What other major impacts of the bill are you seeing out in the marketplace? I mean, is it anything other than what we've covered?
I will, since we have 4 minutes left, I will talk about carry. I think there's a lot of people wondering how the new carried interest provision. So just as a 2-minute overview, it used to be that when you got your carry allocated to your GP deal, as long as you had the investment that generated the carry for more than a year, which most people did because of the way the waterfalls worked, you long-term, you'd get capital gain on that, right? Yeah. Well, they upped that to 3 years, right? So if you're in the investment advisory business and you get your carry allocated to you and you haven't had the investment for 3 years, you have ordinary income, which is a big big deal, right? It's 37% versus 20. So you're losing 17 cents on every $100 a carry that you get, or $17, excuse me. So a lot of people are wondering, what does that really mean? So is there a way to restructure deals where carry is deferred until after 3 years? You know, that's really something that's on the aggressive side, maybe. Are provisions where in order to avoid clawbacks, maybe you're going to hold off on the allocation of the carry? Well, that seems a little discretionary. So it's these types of things that are being worked through. Do I want to do a dividend recap? Let's say I hit a home run in a business, pay for itself in a debt leveraging transaction within 15 months of buying the business. Well, do I want to do that now? Because I'm going to return my investment to my people, to my LPs. But if I kick in carry at that point, am I gonna end up having the P tax at ordinary rates? So what they did with carry introduced a lot of questions about what that holding period is going to look like and how should I structure my carry. So I think maybe you're going to see some people doing that, and that's kind of a big deal. So I'll leave there. That is a much longer. That's a webcast of its own.
No, terrific, and I want to thank David Seitz on behalf of the New York Alternative Investment Roundtable for a very comprehensive, in-depth analysis of the tax reform legislation. 2 minutes. I have been receiving questions from the audience throughout. Are there any other questions that we didn't cover? Any audience? Final comments from you.
Talk about the pass-through deduction. That's a big deal. To the extent people are earning money through pass-throughs, certain types of income is now going to qualify for what essentially amounts to an effective rate of 30% at the individual level because they're putting a deduction for certain pass-through. I will just say this. The pass-through deduction is wrought with complexity and landmines like the rest of this bill, but it's something that should be considered, right? Because 30% all-in money is pretty attractive when you compare it with the other types of investments. So the pass-through deduction generally favors capital-intensive, labor-intensive businesses. So this one is a little bit of a winner and loser from an industry standpoint, but I would encourage people to look into the pass-through deduction. It was a centerpiece of the legislation, at least a significant part of the legislation, and something that I think is particularly relevant to this crowd. So we didn't talk about that a lot, but it's a really important piece.
Well, it just means, David, we'll have to have you back soon.
Well, I appreciate the time. I'm a busy guy this time of the year, and so I'm glad we could make this work. And if any questions at all, feel free.
Where's contact information here, David?
Contact information is back on slide 2, I think. Let's put it up here. And my email address. It's
there. It's there.
So slide 4. So my email address and my phone number is on there. So feel free. We're always happy to help. I like to say we're all in this together. Let's work through it together.
And David, once again, you have been very generous with your time, and really do appreciate your insights. And this was a very, very interesting session. I'm sure the audience will agree. You've given us a lot to think about. I mean, this is, like you said, drinking from a fire hose. So we're all in this together. And again, I want to thank the audience. And until next time, this is the New York Alternative Investment Roundtable monthly call. Signing off for now. Thank you much, everybody. Bye-bye. Thank you again, David. Bye-bye.
No problem.